Hey everybody, welcome to tonight's webinar on exploring Spartan Investment Group's due diligence process. We have a really fun webinar tonight. We're going to talk about how Spartan conducts due diligence whenever we do an acquisition. So this is going to include everything from doing the due diligence on the physical site inspections to some of the things that we do for the financials of the property, and just kind of go over the site visits that we do, some things that we've found in the properties that have caused us to retrade with a seller on a property, or just things that we just had to mitigate risk upon knowing why we were under contract. So I'm very excited here to be joined by our CEO of Spartan Investment Group, Scott Lewis. And Scott, why don't you go ahead and just give us a little background about yourself?
Yeah, thanks, Ryan. Good evening, everyone. As Ryan mentioned, I'm Scott, the Chief Executive Officer for Spartan. I've got kind of a wayward path to kind of get me where I am now, starting with some framing and contracting in high school and college, which really kind of got me interested in real estate, and a stint as an active duty infantry officer, and some time in the federal government that kind of helped me build what I think is a pretty good skill set for driving kind of through our due diligence process, especially my time in the military and being very, very detail oriented. I've got some educational background as well that helps with project management and some of the financials from business school to kind of really move through this due diligence process. As we'll see, it's not a short process by any means. And we'll talk about that here in a couple of minutes.
Well, great. Thanks, Scott. And again, my name is Ryan Gibson, the Chief Investment Officer for Spartan, and we are going to go ahead and get started. So we today are going to be talking about some things that we do, but we're not offering advice. Seek outside counsel. We're just giving a general overview. Obviously, seek your own due diligence. Seek your own advice. When you do these property inspections, this is a very, very generic, general overview. So don't only do what we talk about, or trust that this is exactly what you should be doing for a property inspection. Definitely do your own due diligence on that. And information here is contained, is subject to change, and obviously perform your own due diligence. So these are some of the webinars that we have. We have a monthly webinar at Spartan Investment Group, and we've done things on mostly private placements. We kind of started off the year on talking about operating agreements for private placements. So when you make an investment with a syndication, or you're a syndicator and you're taking outside investors, we ripped through the entire operating agreement from a high level with an attorney. We talked about the PPM. We talked about self-directed retirement accounts earlier this year. We talked about due diligence, how to conduct due diligence on an operator. So if you're getting ready to invest with a sponsor, the things that you should be looking for. And then we went into a specific deal and we looked at tons of different case studies on the deal. And tonight we're talking about our due diligence process, keeping that same theme opened up. And later on, as we approach the tax season, we're going to get into your capital account when you make an investment, and how a K1 impacts your return in a syndication. When you all receive your K1s, hopefully by the end of February, your investment should be giving you those K1s by that time. So all of these webinars can be viewed on our YouTube channel. So if you just go to YouTube and you type in Spartan Investment Group, that's where all of these webinars are available for replay. We do all kinds of cool things, like when we go to a property and do an inspection, do due diligence trips, do acquisitions trips, we actually do some follow-alongs and some videos and things like that. So check out our YouTube channel and make sure to subscribe. So our theme for the last 3 webinars has been all about due diligence. And if anybody has seen the Netflix, I think it's Hulu documentary on the Fire Festival, a bunch of people were sold on, white sandy beaches and organization and a yacht and all kinds of really cool things. And in reality, they got a bunch of tents and trash and a complete disaster. So that's what we're trying to prevent. We're trying to make sure that not only doing your due diligence on your own projects, but that you're doing your due diligence on the operator that you're about to invest with, and then the specific deal itself, to make sure that you don't have, Fire Festival 2.0. So that's why we're having these webinars. Scott and I have both been invested in deals as passive investors into other people's projects that have been absolute disasters. So, kind of is a big passion of ours to make sure that you kind of learn a little bit about how to not make those bad decisions that we made. I mean, we've come a long way in the past several years to know kind of how to vet an operator and do our due diligence, obviously. So I love showing this slide. I know we've shown it in the last 2 webinars, but risk mitigation starts with you, right? So an operator makes a promise to you, and they say, oh, it's guaranteed and it's gonna make it perfect and all these other things. And really, that's not the case in anything. Nothing's guaranteed in life. Not even a loan is guaranteed, because what if the operator doesn't pay on the loan? And there might not be much equity left to get if the operator is highly levered that project. So, just a lot of different things that you can, there's never a guarantee in anything. So an operator makes a promise to you, run far in the other direction. Lack of business plan and documents. If there's no plan, no strategy, then you're not set up for success. So make sure that you thoroughly vet the documents on any deal. Or if somebody says it's a once in a lifetime opportunity, run to the back of the room, get out your credit card, sign up, don't leave or you'll miss out forever. I always tell my investors, we have a deal every quarter. So if you don't like the deal we have in front of you, just wait a quarter and there'll be another deal. So there's never a once in a lifetime opportunity. Real estate transactions are in the millions and they're all over the place, and there's always another deal. Or no track record. No track record I use a little bit carefully, because sometimes you can lack a track record but still be a good operator, but you just have to make sure you do a little bit of extra vigilance and due diligence on that. So enough of that. We've got Scott here tonight to really just talk about the process of due diligence. So here we are with a project under contract, or maybe it's just under LOI, and we're just doing a little bit of due diligence on the project, or kind of what makes a project sort of attractive, and then what are some of the first things that we do when we start looking into a deal.
Thanks, Ryan. So let's start with what is due diligence, and then we'll kind of move into some of the things that we look at. And I'll say that this is one of, as sad as this sounds, it's kind of a double-edged sword. This is the part of the process that excites me the most. And why? It's because I'm an incredibly risk-averse individual, and most people who know me may think that's crazy based on some of the life decisions I've made with joining the Army and stuff like that. But it was all about taking prudent risk and mitigating those risks wherever possible. And that's really what due diligence is. It's about assessing the possible risk and then determining what risk mitigation strategy that you want to employ going forward. Sometimes you can't get around it. It just is what it is, and you need to accept it. And risk isn't bad. It's when you don't know. It's when we get surprised. We're looking at a deal right now, and we've identified through our due diligence process a potential $1 million in capital improvements coming up. Well, no big deal, but we know about it today. It's when you're 3 years into owning that asset and that skeleton comes out of the closet and punches you in the face that you really have a problem. And the better due diligence you take, and sometimes it's painful. My acquisition guy is always yelling at me. Ryan's always yelling at me because he's the capital guy, and all these guys are super juiced up. They want to get the deal done. And then you got me, which is their quintessential roadblock. I'm what's the green dude in the trash can on Sesame Street?
That would be the Oscar the Grouch.
There you go. So I'm basically I basically inside of Spartan, I live in our trash can, and I just pop my head out to yell at the acquisitions and capital guys during the due diligence process.
This is true.
But it's really about caveat emptor, buyer beware, because once you buy this thing, that seller has his money and he's off on Vegas betting on black, or he's in the Caribbean. You're not getting it back. It's over. I mean,
and I will say that, from a excitement standpoint and buying a deal, I'd probably say the worst deal we've ever done in the history of our company was the deal that had the shortest due diligence time period. Now,
hands down.
We still made money. The project still performed, but it wasn't as good as projected, and that was because there was a lack of due diligence process. And I think one of the problems in this environment right now is that it is a seller's market, and when you get in front of the seller, they're saying, hey, I've got a line of buyers out the door, and they all have much more competitive timelines than you do, and you have this due diligence to do. Why should I sell to you and not everybody else that can close fast? And that's a very frustrating thing in this market, is that you get into those situations and you have to move quickly. So, we've kind of developed a checklist and a process to sort of get ahead of these things so that we can start due diligence quickly and efficiently, so that we can move through these due diligence items and still protect ourselves while being able to competitively put a property under contract.
No, 100%. We'll talk about that in the next slide a little bit, about never develop your processes and don't be rushed by the seller, move on. But really, due diligence and kind of a less jargony Wikipedia-esque definition is really, due diligence is closing the gap between what the seller is telling you is true and what it actually is. So really, it's closing that gap, and the closer the closer that you can make that, or the closer that gap is, the higher probability you will have in not stumbling on an existential risk after you buy the darn thing. I think that this is the most important of all the processes, all of them. Most of the other risks you can mitigate, but if you don't do proper due diligence, it can really, on big commercial assets, it's game over. It's live under a bridge time.
Yep.
On the house flippers out there that are buying homes as is, I mean, they have super thin margins, and they often get just crushed with really poor due diligence because they don't do it. I wanted to just touch on real quick, there's due diligence is kind of an all-encompassing terms. So for us, we really look at 3 different types. We look at physical, and that includes I include the survey and the site stuff within that physical. There's financial, that's the underwriting that the buyer is telling you, and then there's operational. For some of these properties that have ongoing operation, like one of our previous projects, like Mini West Self-Storage, and Charlie's Laser Wash, there's an operating self-storage there, and there's an operating car wash. So you have to understand what operational permits are in place. Now I'll talk a little bit about this, and as long as technology doesn't fail us, we're going to pull up one of our active due diligence trackers right now on our deal that we're putting together currently, and kind of look at that and see the level of detail that we're going into this thing, because it's our due diligence tracker, which we've given out at conference before, is kind of one of those things that really drives our process. So with that, why do we do due diligence? I mean, we talked about it a little bit, but we trust nothing and verify everything. And I'll give you two stories. I've got one where I learned kind of, I talked about my Army career setting me up for success on due diligence. Well, I'm an officer, and in the Army, as an officer, we have to sign for all of this stuff in the unit, all the weapons, the vehicles, all the equipment, all that stuff. The officer signs for it. It's called your hand receipt or your property book. Well, when you take over a new unit, you have to go in and you have to do what are called physical inventories, i.e. due diligence. You have to verify what's on that hand receipt is actually what you're getting. So luckily, I was able to learn vicariously through one of my other adjacent platoon leaders, and he was going through and he was signing for all this equipment. And there's this piece of equipment that was a biometric identification piece of equipment, and it came in a case. So he went in and he's like, oh, well, there's the case, and he signed off on it. But what did he not do? Didn't open the case. So what was not in there? A $10,000 piece of equipment. How much did he write a check for? $10,000. So that was a lesson learned I learned early on, which really kind of set me up for success on this stuff. Is just because somebody tells you it's there, that means nothing. Verify everything.
I'm invested in a deal right now, actually, where the seller gave the buyer the survey, and the buyer took the survey for face value, and it was a forged survey. Didn't come from the city, it was unverified, and the property's been in litigation now for 3 years.
And that's it. Like, most folks are like, well, I have contracts and all this other stuff. Contracts are phooey. Unless you're going to actually put together the resources to enforce those contracts and go through the time in which it takes, that contract isn't worth the paper that it's written on, because it can take years and years. And if you're going after these big assets, well, I mean, if you've bought it and it's not cash flowing when it was supposed to, you don't have years and years. That freight train of debt service is going to be running at you. So the financial due diligence, we've got this last deal. We got a $200,000 retrade on this because of the level of financial due diligence. We identified an anomaly in the projected revenue, and we noticed that it was 8 months that was being projected forward, when really it should have been a 12-month look. Well, that was a difference of $15,000 in revenue. Okay, so what? Well, on a 7 cap asset, that was a $200,000 retrade that we went in and we said, hey, like, this was it. Like, and the seller hadn't, I mean, they always have a choice, but he wanted to sell the property to us. So,
well, and we could be very reasonable with the retrade, because we had it documented and we said, hey, you projected this much revenue and there is only this much revenue. So we have a documented reason to reduce the sales price. It wasn't just us being tough guys.
Yeah.
It was a logical, straightforward retrade. And, sometimes the sellers will say, hey, take it or leave it, right? And they certainly could have done that. But that's the kind of a relationship you form with the seller. And I think that's another important thing that we should talk about is, these are brokered transactions, but sometimes doing due diligence is just getting into getting your broker comfortable with you talking to the seller on some things. And sometimes it's a faster flow of information when you actually talk to the actual owner of the property who's selling the property. If you can get to that, that is the holy grail of really creating a good relationship and getting some good information.
And the last tool that we'll examine is our internal baseball cards that we do on each of our folks that we're dealing with, so that we understand how those conversations need to go. And we have a reputation for the utmost integrity. So most of the time we get connected directly with the sellers, because the brokers know no matter what, doesn't matter what happened, they're going to get their cut. We'll never cut anybody out, but it's just sometimes it's easier to streamline it, and we're not an emotional buyer, so we don't get we don't get very emotional in this stuff, because it's all like it either adheres to the checklist that we have or it doesn't. It's really that simple. So let's look at some key aspects of our due diligence process. And this is internal to us. And these are just kind of overarching principles for our process. We never rush. So as Ryan mentioned, it's a seller's market out there, and we get pressured all the time. Well, you need a 30-day due diligence. We're gonna move on, because as painful as it may be to pass on what you think is an amazing deal, it's far more painful to lose that deal, or lose investor money, or get into a situation where you're worried every day on what you're going to do. I mean, as Ryan mentioned, both of us are in really bad deals, and it sucks. And I'm sure one of those deals, in full disclosure, is with my cousin. So I have a personal relationship with him, and it really sucks for me to say, hey man, like this is going real bad, and you better figure something out, or lawyers and all this other crap is coming into that. That sucks.
Yeah, it's not a fun thing to be in. So when you have a short time frame, I kind of cringe, and I see case studies presented of people that had to move fast through due diligence and put up hard earnest money, and then you hear those deals come out the other end and they're just mediocre and they're stressed, and now you're stuck with this thing for 5 years. And you've got to just have a painful process versus just saying, you know what, plenty of deals out there. We're going to pass on this one. We can't adhere to our due diligence time frame. And I think the other important thing too is make sure you have your due diligence process set up before you go looking for deals, so that you know what to look for once you get that opportunity to go to due diligence. When you get into your due diligence phase, it's not the time to start learning due diligence. Now, you're always going to learn something when you go through due diligence. Like our checklist was 200 lines, then it was 300 lines, then it was 500 lines. So now it's really grown, because you're going to learn stuff, and it's important to have the pre-mortem, which is what we're going to talk about later. After a deal closes and everything has gone through, we always debrief our deals and say, hey, what did we learn? What could have gone better? Who dropped the ball, or who could have picked up the ball? Or, kind of let's talk about, process improvement after you do a deal, so you can learn from it.
Yeah, so that's, inside of Spartan, we have a kind of it's a Kaizen, right? It's a Japanese word for continuous improvement. And that's really like using that post-mortem at the end of that to really kind of like drive, or the after action review to really kind of drive that process improvement and that learning. We also are going to look at a tool today that not a lot of people have ever heard of called the pre-mortem, to really kind of look at setting the stage before you even start. But that's part of our process, and that's really what we are. We're process driven, and we did develop this process. Now it's constantly like evolving, and I'm stopping real quick because we've got a question on the audio here.
Yeah, can everybody hear us okay? Tim, sorry about that. Does everyone have audio but me? Okay, James, thanks. Tim, I'm not sure. Maybe turn up your computer volume.
Tim, get a new phone. The flip phone you've got from 1997 doesn't work.
No worries. Okay, well, we'll keep going.
All right, so we're process driven, and yes, it's a culture of constant improvement. So that process does change, but we're probably not much more than 15% or 15 degrees off center. Now this is kind of a running joke inside of some of my circles and Ryan's circles that we have checklists for everything. I think we have a checklist for some of our checklists, but it guides us. There's plenty of things in our business that we have to think about. The steps in our due diligence process shouldn't be one of them. That's just brain power that doesn't need to be there. That's why, we're really kind of guided with Ryan being a commercial airline pilot and me being a crazy Army guy. I mean, we have checklists for everything, and there's a reason for that. It's because we only have so much mental capacity, and the rest of it needs to go to where like is really important decisions. So those checklists just ensure that we do the same thing every single time. And as Ryan mentioned at the start of the webinar, we do not get pressured into closing. We just don't. We'll walk away from a deal at the end of the 11th hour if we have to, if we're not finished. But as Ryan mentioned, we're very clear up front with the brokers, and we have that dialogue right away, so nobody gets surprised. It's like, hey, here's our process. We show the brokers our list. It scares them most of the time, but we're full disclosure, we're going to go through this. And if we get all the documents, which I'll talk about, if we get all the documents that we need, we can put this together in 30 to 60 days, no problem. When we don't get what we need, that's when it's a problem.
It's kind of like taking a sailing trip. If you're rushing around trying to get off the dock and you don't put enough fuel on, you don't chart your course, and you don't see where the shallow ends are and deep ends, and you get on the boat because you got to go. You got to get out there. You get out there on the sailboat and you're set sail for 3 days, and you realize you forgot some stuff.
Yep.
And man, does that make for a not fun trip. Like maybe you didn't pack enough snacks, or you didn't pack enough fuel, or you didn't pack the right map or something, right? So take your time on the dock, have your checklist that you run for the ship, and get the things done, because in aviation, we call it setting the parking brake. When we're not ready to go, we don't release the parking brake, and we're the last line of defense in this disaster. So, we have to assume the bags were loaded on, the checks were done, the maintenance personnel has done their procedures, and then we run a big, long checklist before we push back. It's no different than your real estate deals. You just have to come up with that checklist before you go through it and understand what the checklist means.
So I'll talk a little bit about kind of our overarching process, and there's really kind of three key components to it. And that's the people, the tools, and our processes. And I'll decompose the people a little bit on the next slide, and I'll talk about 3 tools to just give some folks some examples of some of the tools that Spartan uses. But I want to talk about the process first. It doesn't matter what process you use. That's not relevant. It's really important that you have a process. So some folks that are listening to this that have jumped onto our YouTube channel, or they hear us on podcasts, or they see us on stage and they're just getting started, they're like, man, I don't even know what to do. Well, you know what? Like doing some research and coming up with the 20% solution to get you started is better than not having anything at all. So again, Spartan's processes, they're really focused around people and tools that enable us to move through these processes. One of the things I will say that should be the start of every single person's process, and we do this as a matter of our contracts, is we have formulated a list of due diligence documents that we need right out of the gate. And if those documents are not provided to us, our due diligence clock does not start. Now, we've heard from brokers that that's hugely beneficial because they know where they're starting from. It's like, hey, here's the process. And they get that early on, even as we're negotiating the contract, going back and forth on little terms here and there. Because we've drafted that out and we've given it to them, that gives them a couple of extra days to work with their sellers to say, listen, I need these documents. These guys will move fast, but they're not going to budge from this whatsoever, unless there's a really darn good reason as to why we should. So with that, let's look at some of the team members that you can have inside this process. And it doesn't necessarily mean just internal to the team. Now, Spartan has a bunch of people inside that can help us or help me kind of manage. I'm really our due diligence manager. But leveraging those external folks to really get their expertise and bring them in early on. Like we have a civil engineer review our site plans from what's that thing called? Google Earth.
Yeah. So what was the first thing that we did on Mini West? We had a civil engineer review the site and make sure that, hey, how much can we build on this property?
So that was the thing. We can read the zoning code, but getting a second opinion from a civil engineer that can also lay this out with stormwater and all these other requirements is huge. Bringing a general contractor in. Hey man, I need to. We're doing this. They're not a general contractor, but they're specialty contractors. Right now, we're bringing them into a deal we're doing due diligence on because we know we've got some major capital improvements coming up, and that was identified by our building inspector. But we're getting specialists out there, the contractors, to tell us A, what's the real story here, and B, how much it's going to cost, and C, how long does it take to do it, so that we completely understand. And we're bringing these external people in. So many folks skip some of the steps of due diligence because it's expensive. Environmental consultant, that's $2,500 out the door, no matter what, doesn't matter. Surveys, that's $5,000 to $10,000 right out of the door, automatically. To do our due diligence, depending on the deal, if there's no building component to it, it probably only costs $10,000. If there's a building component to it, I mean, hell, our deal up in Black Diamond, where are we at? I mean, our due diligence is probably $50,000 on that thing.
Yes.
But I mean, people were like, "Oh man, you should spend $50,000." I mean, it's a $12 million deal. Who gives a crap about $50,000, right? But it's protecting us so that $50,000, yes, you might lose it, but you need those folks that are out there that are going to be doing this. You got to stop looking at that money or pursuit costs, as we call them in here, as a loss. That's a gain. Now, yes, it's money that's gone out of your business, but hey, welcome to real estate. That's the cost of doing business. But what that did, that money that you spent on due diligence that is quote unquote wasted because the deal didn't go through, you know what that did? That allows you to sleep at night. Because if you're in a situation where you spent $25,000 or $30,000 and the deal died, how much money would you have spent if you had not spent that and the deal went forward and was a disaster? You didn't do an environmental scan and you bought a brownfield. And then the EPA is coming out, oh, well, that's great. You got a 5-acre part that you got to take off 3 feet of topsoil on your entire thing. There's $1 million gone out of your deal, right? So that's why we really we have no problem paying for team members and attorneys. I got more attorneys in my life now than I even knew existed.
I think I have more attorneys than I do friends. I have a lot of friends too.
Yeah,
I'd like to think I do anyway.
Yeah, I definitely have more attorneys than I have friends. There's not even a doubt in my mind.
I mean, we have land use attorneys in every single market that we're doing business in. We have land use attorneys in Washington, Colorado, Texas.
Yeah.
We have land use attorneys in DC. And we're hiring these consultants for every single project because these are the people that are licensed by the state and entrusted by the state to do the research and know the codes that are going to allow you to be matter of right. And, it doesn't completely relieve you of your responsibility. You do have to make sure that you're checking what they're doing and making sure that you're kind of trusting but verifying their work. But very good point.
So just real quick before we jump on, there's 2 other points I want to make here for using external team members. One is errors and omissions insurance, right? So when you use external folks, you've got a little bit of protection in regards to them making mistakes using E&O. The second thing, and this has helped us, as Ryan said, we are very fair and reasonable people when we're doing our due diligence. And oftentimes having a third party who's neutral to this come in and say, hey, you're going to have to replace an HVAC system and it's going to be $250,000. Well, taking that to the seller is much different than you just coming up with something. And leveraging the expertise of that third-party consultant as to help the negotiations along to demonstrate the reasonableness of your ask. All right, so let's get into our tools. So our due diligence tracker. I know it's super small on there, but that red circle is circling a number that's 589. We don't actually have 589. We have 588 because that's counting the one
that's counting the blank line.
That's counting the blank line right there. So as you can see, we have decomposed our due diligence to all of these different sections of it, and eventually I'm committing on this webinar. Spartan is going to write a book on this because all we would have to do is write 1 page per line here, and we've got a really almost like a tomb. Like a college textbook that we can write on. But we go through this on every single deal that we do. I'm going to try to jump over and open up our due diligence tracker for one of our deals, and I was successful.
So this is a live document of a property that we're doing due diligence on right now.
So each one of these lines has an owner, so everybody knows who's doing what. And then one of the key things that this is number one, the status, the red light, the red, yellow, green indicator. Any red light before we close on this deal will have notes in it to say why it's still red. We will only close a deal on 3 things: green or yellow, that's fine. Gray is not applicable. Red has to have notes on it before we go forward. The other thing that we look at that people often get caught on, especially when you have a team doing due diligence, is facts or assumptions. A lot of times folks take something that's an assumption and call it a fact, and that causes problems later. But as you can see, as I scroll through this, every one of these lines has the stoplight chart, and we go through this every single process. So we talk to folks out there that want to be active versus passive investors, and I often use this to say that, are you willing to do this? If the answer is no, give your money to us. I mean, honestly, that's just what it is, because we're going to go through and do this. So, this is the level of rigor that we go through for every single one of our deals. And it's painful. It's really painful, but it protects us. It protects our investors. It protects the property. It kills a lot of deals. And that's unfortunate, but it just is. And it really kind of gives us a really good, thorough understanding of the deal going forward, so that we can then tie this into the business plan to make sure that anything on here that's yellow or potentially red, it's not a bad thing. It's just that we know about it, and we can mitigate that risk in our business plan going forward.
Yeah, and I will say that, sometimes, like I said, you're going to learn as you do these things as an operator. One project in particular that, we learned a great lesson from, that actually will help us better negotiate deals in the future, is wetland mitigation. We had critical areas on a property that delayed us over a year. And, for a future project that we're looking at in the state of Washington, there was critical areas. And before we agreed to go under contract, we had to make sure that those areas had been vetted and certified by Fish and Wildlife, DOE, any tribal comments, anything that went into that, and we were refusing to close on the property before all those things had been vetted. So it kind of makes your negotiation a little bit stronger, and the seller is going to know that might know that you're a little bit newer if you're not concerned about those things. So we really pushed back on that and made a big deal out of it because of our experience doing it. So some of this is experience, some of this is learning as you go, or hearing from others, or just learning as much as you can in the process. So very good.
All right, so let's look at another tool. So the next tool I want to look at is our pre-mortem. So Ryan mentioned a post-mortem earlier in our process, and I think a lot of folks are familiar with the post-mortem or the after action review, where it could be a good thing, but most of the time postmortems are done under bad conditions. When something epically failed, you look back and figured out why. Well, honestly, inside of Spartan, we think that's stupid, because why look back on a failure when you can look forward and try to predict a good portion of what went wrong by using the pre-mortem? And that's before the deal even starts. So our process for this, I'll talk about it a little bit, and then I'll give an amazing example that was just like, it was baffling to our team how we were able to do this. And we looked at, like, what does the failure look like? Why did it happen? What can we do to decrease that risk of failure up front? And then who's responsible? You got to always talk about who's responsible. So I'll give a story, and this will also tie into our next tool, the baseball card. So Ryan and I and our team were sitting at a coffee shop right before our conditional use hearing for Black Diamond self-storage. And we were going through our pre-mortem, just the checklists, and one of them was there, and the failure was something to do with the hearing examiner. And one of our team had asked about the hearing examiner, saying, hey, like, do we know anything about this person? So we were still assessing before we went into this conditional use hearing, and we caught this just minutes before. Well, we have a director of business intelligence who's got a particular skill set that's fun to utilize sometimes. So we called her and we were like, hey, can you find out some stuff on the hearing examiner? Long story short, after some intelligence gathering, she came back with, like, hey, I've analyzed several of his decisions, and what it seems to look like that he's really interested in is the impact to traffic and the amount of trips that a commercial project will generate. It's called a trip count. Like, okay. So then we asked the question, like, hey, is there a heuristic for self-storage for the number of trips? Well, yes, there is. It was like, let's just call it 7 per 100 units, because I don't want to do math. It was close to that. We're like, okay, so this facility, about 800 units. So that's 56 trips per day. We're like, okay, cool. So we get into this hearing, and it's going, whatever. And, like, the hearing examiner gets up there, and Ryan's the one leading the charge here. And if you guys have seen the movie Old School with, like, Will Ferrell up there when he's, like, at the debate club, when he, like, kind of, like, gives this amazing like answer, but he's completely passed out. He doesn't know what happened. I think that's kind of what happened here during this, like, conditional use hearing.
Thanks a lot.
Well, no, I mean, it was absolutely brilliant, because the hearing examiner comes up. He's like, well, guys, I just have one question. He's like, how many trips is this going to generate per day? And Ryan's like, 56. And the guy's like, can you explain that to me? Ryan's like, yep. Self-storage per the almanac, 7 trips per 100 units, 800 units in our facility, 56 trips a day. Guy's like, all right, well, thank you very much. That's my only question. And it just moved on. And we looked back on it, we're like, oh my God, the pre-mortem, like, we would not have known that had we not done this pre-mortem. So that's really the power of this thing that we do. The last tool I want to talk about, and I've redacted some of the information here from this particular person, but whenever we have a person of interest, and that can be I redacted all the information, a person of interest that is, hey, whether we're going into a negotiation or whatever, and I highly recommend people do this whatever they can. We look at, hey, what can we learn about this person, because what is important to them? Or, hey, are we dealing with somebody that has bad values? Do they have, like, bad stuff on their records, or do they contribute to a particular charity that we align with, right? It's establishing rapport and assessing risk. And really that's our baseball card, and we do this basically on every deal going forward, and then whenever we have a key person of interest. So with that, I'm just going to kind of give some final thoughts, and then we've got some time for any questions that folks have out there. And as I said, I really feel that this is the absolute most important part of the process. You can make a lot of money and you can lose a lot of money in due diligence. Feasibility and due diligence are different. So in Spartan, and much to the chagrin of our acquisitions guy, we break this up into 2 different parts of the deal. Feasibility and due diligence, they answer different questions. Feasibility really answers like, is it feasible to do what you want to do? Is it feasible to build a facility and lease it up? Is it feasible to take over an RV park in West Texas and turn it around and fill it up based on oil cycles? Due diligence is much different. Did they permit the septic system? Are they operating per code? Do they have a certificate of occupancy? All that other stuff. They are very different. As investors, any of our investors that are listening on this call, or any new investors that are interested in investing with us, you want to grill your sponsors on this. How are they protecting your money? All the like BS in the offering memorandum and all the stuff in the PPM, like that stuff is all it's important and you should read it and listen to it, but ultimately you want to understand what they're going to do to protect your asset. The numbers are just numbers. Anybody can cook those books, but the due diligence is what really protects your asset, right? It's really what makes sure that you're safe. And if those sponsors hesitate or they don't have a great answer on due diligence, then I would be very leery. And hope is not a strategy. Verify everything. A lot of times I hear in meetings, well, I really hope. Well, that like, don't hope. Verify everything.
So with that, we're going to go ahead and wrap it up for questions. Thank you so much, Scott, for dropping all of our wisdom on that. We have, I think, kind of just to add my 2 cents to the end, when you're making an investment decision, you've got to make sure that, from our previous webinars, we talked about all the offering docs. That's like minimum stuff. But like Scott said, I think the due diligence is where it really gets to, really where the rubber meets the road, making sure that you go through all of those due diligence documents. In our process, what we do is once you're interested in a deal and you see the offering memorandum, which we've talked about before on previous webinars, the offering memorandum is just it's marketing material. It really doesn't tell you the nitty-gritty of the project. So once you kind of see that kind of gets your interest. And then once you kind of fill out our purchaser questionnaire, then you can really look at what's going on. When you get the due diligence documents, the investor folder, kind of go into the heart of the project and see what the operating agreement says, which we've talked about before, and the PPM, and then see what due diligence has been done on the property. Sometimes these properties, like we have not completed due diligence on in one of the current offerings that we have now, but we're pretty close to being finished. And you kind of have to know that due diligence kind of runs in parallel while you're raising capital, because sometimes deals, you can't get them closed in the timeline that you have for due diligence. You kind of have to start that capital raising process a little bit earlier, and it's kind of a parallel effort. We've had a deal fall apart. We've actually had a deal, and I'll give closing thoughts. We've actually raised full capital for a project, got all the way to the closing table, and decided that, well, we didn't decide. We couldn't get title insurance because the seller was fraudulent.
The property was stolen from somebody. It was crazy. Bananas.
Yeah, so we had the title policy process caught it, and we actually say in our contracts that after due diligence period is waived, one of the reasons we can walk away from a deal between the end of due diligence and actual close is fraud of the title. So in that case, all the investors got their money back and we canceled the deal. It was unfortunate because it was a really great project, but we couldn't do the project because we couldn't get the right.
It was going to litigation for years.
Yeah, we couldn't get right to the title. So, well, anyway, that's what that kind of wraps up our webinar. Our contact information's on the screen. We're going to go ahead and open it up for questions. I know that there's going to be a lot of questions tonight. The first question we have is, do you do baseball card on all your investors? And the answer is no. Great question. But no, we don't. We just do that on any partnerships or anybody that we are considering doing business with or JVs with. We do a deep background investigation on. It's real estate. There's too many shysters out there, and it's a confusing business as it is. So we do background checks, and obviously we've walked away from partnerships based on what we find in our detail background checks. We use systems like LexisNexis, TLOXP, Some things you can find in a Google search pretty fast. If you're partnering with somebody and they don't talk about what you can find on them in Google, if it's bad, that's probably a red flag. I would put, in Google, the person's name and SEC and violations and things like that. You'll find all kinds of stuff on people that have done the wrong things in the past. And, the first thing you don't want to do is, if they're going to blame this person and blame that person, run fast. So next question, are you willing to share the current due diligence doc with us tonight? Or do we have to come to a conference?
We can absolutely share that out tonight, but you still should come to the Best Ever Conference and meet us in person.
Absolutely.
And I don't know if is it James or Jim or
James.
So yeah. James, you're right as regards to how much the overlap is from the military service. One of the key things that we use inside of Spartan is the military decision-making process, which the Army uses. And we've taught the entire team here on how to use MDMP in making very structured decisions in complex and uncertain environments. It's how we built our strategic plan, and it's how we make decisions internally. So luckily I've got an amazing team that stomachs my military analogies, and they stomach Ryan's pilot analogies too. So we beat them up over the head with a bunch of external stuff. So
yeah, the next question, great question, James. Thanks for that. How did you come up with a checklist like that? Is it built over time or purchased somewhere? Thank you. So I would probably say it was built internally, yeah. and you don't get anywhere in real estate without other people helping you. So to say that you're self-made or you do this on your own is, I think, complete BS. So we've had we go to masterminds, and there's other operators there that have checklists of their own, and we've merged those checklists, and we've given them our checklists, and we all get better at this. By the time you're under due diligence and you're doing your due diligence on the project, you're really not competing with anybody. So that's why we're okay with sharing this information. It's, we just don't want to see people do bad deals, and we kind of want to separate ourselves from, people that just want to rush through due diligence. I mean, I'd rather have all the buyers out there wanting to do their due diligence. As a seller, we're going through the sale of a property right now, and we're making it really easier on the buyer because we have all of our due diligence documents organized. So it's very easy to buy a project from us because everything is where it needs to be. And, I just encourage you as a real estate professional, either as a passive investor or active investor, have your process down in house and make sure it's being done so that you're part of something that's great.
And I will say, just anytime somebody gives somebody a tool, the tool itself is not necessarily all that helpful without the operator. So just we absolutely will send this out in a PDF after this call, but just really make sure that you have the internal processes in place and the people in place to be able to leverage that tool. It's not an easy process, and it takes a lot of time to be able to do that. And if you're on this call, that means you're connected to Spartan in some way, somehow. So we want to make sure that we help you out wherever we can.
Yeah, and that's a really good point. I mean, taking these due diligence checklists out of context can be a disaster in itself. Yep. I mean, I mentioned earlier how the due diligence talks about getting a survey, right? Well, who do you get the survey from?
That's right.
Right. So
and what kind
and when and how outdated is it, or is it dated or whatever. So make sure that you have the context around the actual due diligence checklist to know what you're asking for and why you need it. Because sometimes I think Scott mentioned it, but just to reiterate, those gray dots we determine are not applicable to a particular project. So if there's a gray dot that may say, we may not need to do a phase 1 environmental, or we may not have to do a survey, or maybe it's not relevant that the zoning code is a certain way because the property is already fully built and we have no plans of expanding it. Yep. And it's already in current use. So there's a lot of things that can come up, and just make sure that you understand the context of the checklist. That's all I'm trying to say. And that comes through going to conferences, and we're not saying any particular conference is any better. We're not selling any conferences.
Yeah, we are. The Best Ever is amazing. You should all come to the Best Ever conference in Keystone.
You should. Absolutely. Absolutely. Yeah. Best Ever conference. Yeah. But make sure you educate yourself on this. I mean, to get a college degree, you spend $250,000, you know, and you know, what's $5,000 to go to an event and learn a little bit about due diligence, or maybe take a class on due diligence. It's really, really important. So, well, thank you everybody tonight. We have time for one more question if there's any left, but otherwise we're actually going to end early tonight, which is pretty awesome. We'll spend that time sending out the due diligence checklist. Make it easy on me if you wouldn't mind. Just email me. You can see my email there, ryan@spartan-investors.com, and I'll reply with the checklist. And that's a way that you can get it. So appreciate you guys supporting us and attending the webinar tonight. And we hope you have a good rest of the week.
Thank you, everyone.